between 2018 and 2020, while every news channel, every press conference, and every political rally in the United States was busy selling Donald Trump's historic trade war against China to the public, while tariffs on hundreds of billions of dollars worth of Chinese goods, sanctions, and slogans like "Bring jobs back home" convinced millions of Americans that Washington was finally standing up to Beijing. Another story was being quietly written behind the scenes in those exact same years. BlackRock, JP Morgan, Goldman Sachs, and the rest of Wall Street's largest institutions were channeling roughly $1.4 trillion into Chinese markets, with 2020, the peak of the trade war hysteria, also marking the peak of these capital flows, leaving us with a brutal question. Who was the real target of this war? And for whose benefit was the stage actually being set? The common reaction is to assume this was just bad timing, that Wall Street somehow misread the politics, or got caught off guard by Trump's tariffs. But once you zoom out and look at 300 years of monetary history, you see this for what it really was, not a mistake, but the next round of a precise, well-worn, four-stage mechanism that has operated every time a reserve currency system has over-expanded, debased its money, and hollowed out its own middle class, while the elites who understand the architecture quietly move their capital to the next rising power and leave ordinary people holding increasingly worthless paper. To understand why $1.4 trillion went into China in the middle of a supposed economic war, you first have to understand how this mechanism is built in stage one. Financial elites create or capture a central institution, a central bank or its functional equivalent, that gains a monopoly over money creation. The government issues debt. The central bank and its primary dealers turn that debt into money, and that money circulates throughout the economy while a narrow group of insiders earn interest and fees on the very lifeblood of the system. In stage two, that money creation monopoly is used to finance government expansion and imperial ambition wars, welfare, infrastructure, global military bases, ideological projects, all funded by ever-growing debt instead of politically painful taxes. Everything looks like a miracle. The currency becomes widely trusted. Foreign states hold it as reserves. The issuing country's assets are in demand, and its citizens are told they live in exceptional, permanent boom. But then stage three arrives, the system overextends. Debt grows faster than the underlying productive capacity. Monetary expansion becomes a habit rather than an emergency tool, and the currency's real value begins to erode. You see structurally rising asset prices, stagnant real wages, creeping or surging inflation, widening inequality, and political dysfunction. Finally, in stage four, the part almost nobody sees in real time, the very same institutions and families that built and ran the system begin shifting their capital to the next power center before the crisis becomes obvious to the general population. By the time ordinary citizens realize their currency is in trouble, their pensions are underfunded, and their savings by dramatically less, the architects have already re-anchored their wealth to another jurisdiction, another monetary base, another imperial core. If you look at 19th, 20th century Britain through this lens, the pattern is obvious: the creation of the Bank of England, its deal to lend to the state and monetize government debt, the ballooning obligations of the Napoleonic Wars, and the rise of the pound sterling as global reserve currency were classic stage one and stage two, centralized money power married to an expanding empire. For a time, it looked unbeatable. The Royal Navy ruled the seas. London was the world's financial capital, and foreign governments settled trade in pounds. But as the 19th century rolled on, British industrial growth began to slow relative to Germany and especially the United States, while the costs of maintaining a global empire escalated. Debt loads crept higher, domestic strains intensified, and, quietly, British capital began flowing into American railroads, steel, and industry. The same networks that once sat at the pinnacle of London finance were building outposts and ownership stakes across the Atlantic. By the time Britain was forced off the gold standard in 1931 and the pound's role as unquestioned reserve currency collapsed, the key elite institutions that had dominated the sterling system had already established their next architecture in New York. The British middle class, however, did not understand this until long after the damage was done. Weimar Germany offers an even darker version of the same mechanism. After World War I, the Treaty of Versailles loaded Germany with 132 billion gold marks in reparations, an impossible burden. Faced with this mountain of external debt and internal political turmoil, the Weimar government and the Reichsbank chose the printing press. What is often described in textbooks as an unfortunate policy error or incompetence was, in many respects, a deliberate destruction of domestic obligations, war debts, internal claims, and most importantly, the savings of the German middle class. Between 1921 and late 1923, the money supply exploded, prices went vertical, and by November 1923, $1 purchased 0.2 trillion paper marks. Workers were paid multiple times a day because their wages lost value by the hour. A loaf of bread went from a few hundred marks to hundreds of billions. Savings built up over generations vanished in months. Yet when the crisis reached its peak and Germany introduced the Rentenmark in late 1923 to stabilize the system, the price of that solution was deep foreign involvement, most notably American capital through the Dawes Plan. U.S. banks and corporations extended loans, refinanced obligations, and took position in key sectors. When the global system seized up in the early 1930s and German politics lurched into catastrophe, the same international financial networks had already shifted exposure and were positioning for the next configuration of power. Then came Bretton Woods and the US dollar's ascension. In 1944, with much of the world in ruins, representatives from 44 nations agreed to a new monetary order. The US dollar would be pegged to gold at 35 per ounce, other currencies would peg to the dollar, and foreign central banks would have the right to redeem dollars for physical gold. This was stage one, and stage two on a global scale. The US, with the largest gold reserves and intact industrial base, became the core of the system, and for roughly 2 decades, the arrangement seemed stable. Europe and Japan rebuilt under the umbrella of the dollar. International trade and capital flows grew. The world gradually came to treat the dollar as good as gold. But as the Cold War intensified, as America fought the Vietnam War and launched ambitious domestic programs like the Great Society, U.S. policymakers chose the same path their predecessors had. Instead of matching spending with politically painful taxes, they leaned on the power of the reserve currency, running persistent deficits and expanding the supply of dollars. By the late 1960s and early 1970s, there were far more dollars circulating globally than the U.S. could credibly redeem for gold at 35 an ounce. Foreign governments, especially France under Charles de Gaulle, saw the writing on the wall and began demanding gold in exchange for their dollar reserves. In August 1971, with only around 10,000 metric tons of gold left and a stream of redemption requests, including a British demand for $3 billion worth of gold transfers, President Richard Nixon closed the gold window. Overnight, the dollar ceased to be a gold-backed promise and became a pure fiat currency. Since that decision, the dollar has lost over 98% of its value against gold, but the fiat architecture supercharged Wall Street low interest rates, financial engineering, derivatives, share buybacks, and global carry trades became standard tools. The U.S. could externalize much of the cost of its deficits by exporting inflation and debt to the rest of the world. Elites close to the monetary spigot made fortunes, while the American middle class endured decades of wage stagnation, rising living costs, and asset bubbles that kept putting homes and real assets further out of reach. Now, look at Trump's trade war through the same lens. On July 6, 2018, the U.S. imposed the first major tariffs on Chinese goods, $34 billion worth, marking the official beginning of the trade war. The narrative was emotionally powerful. America was finally fighting back, rebalancing trade, punishing unfair practices, and promising to bring manufacturing and jobs home. Politicians in both parties lined up for tough talk soundbites, and mainstream media framed it as a dramatic geopolitical confrontation. But just 1 month earlier, on June 1, 2018, something far less dramatic but far more important to the global financial system had happened. MSCI, one of the world's most influential index providers, officially began including China A shares in its flagship emerging markets index. That small-sounding, technical decision flipped a structural switch controlling hundreds of billions, ultimately trillions, of dollars. When an index provider like MSCI assigns meaningful weight to a market, every institution that tracks that index or hugs it for risk control reasons, pension funds, sovereign wealth funds, life insurers, mutual funds, university endowments, must allocate capital to that market to avoid tracking error and policy violations, regardless of whatever political speeches are being made on TV. Between 2018 and 2020, China's weight in SCI's emerging markets index surged from almost nothing to over 40%, meaning that, structurally, around 40 cents of every dollar tracking that benchmark now had to find its way into Chinese assets. During that same window, U.S. portfolio investment in China climbed to around $1.4 trillion, with 2020, the supposed hottest year of the trade war, also being the peak year for these flows. Simultaneously, BlackRock expanded its onshore asset management and wealth management operations in China. J.P. Morgan gained approval for a majority-owned securities venture there. Goldman Sachs increased its stakes and deepened integration with Chinese counterparties. In other words, the institutions that had sat at the core of the post-Bretton Woods dollar system were systematically building presence, infrastructure, and ownership inside the very financial system that is now emerging as a strategic rival to U.S. dominance. On television, Americans were being told that tariffs were punishing Beijing on their behalf in the footnotes of financial filings and index rebalancing memos. The elite capital of the dollar system was embedding itself inside China's market architecture. When you overlay this on the U.S. macro picture, a national debt in the mid-30 trillion range, up to GDP ratio around or above 100%, A Federal Reserve balance sheet that swelled from under $1 trillion in 2008 to nearly $9 trillion after COVID and still sits dramatically elevated. You see exactly the hallmarks of stage 3 overextension, a domestic political system addicted to cheap credit, an economy that cannot function without ongoing monetary support, and a currency whose long-term value is being quietly eroded. In that environment, stage 4 doesn't look like a conspiracy theory. It looks like rational self-preservation by the people who understand how the machine works. To the average American, the trade war was a patriotic spectacle, flags, rallies, sound bites about winning, and standing up to China. To the monetary architecture, it was cover for something else, a period in which US-based financial giants could deepen their foothold in Chinese markets, while index providers and regulatory regimes normalized massive Western capital exposure to China as simply part of standard portfolio construction. Corporations, meanwhile, did truly bring manufacturing home. They diversified supply chains, invested in automation, and continued to seek lower labor costs and higher margins, even as they publicly nodded along with the political narrative. The brutal truth is that the incentives of politicians and the incentives of the monetary financial complex are not aligned. Politicians need headlines, short-term approval, and election wins, so they stage fights in public. The architects of the financial system operate on longer cycles, cross-border, largely ideology agnostic, focused on preserving and growing capital through whatever structure hosts the next round of global power. That is why, throughout history, when a reserve system becomes overextended, insiders extract profits, build exposure in the next host, and let the old system's middle class absorb the loss through inflation, devaluation, and broken promises. For ordinary people today, that means if you keep your wealth primarily in domestic fiat claims, low-yielding cash, long-dated bonds, underfunded pension promises, you are structurally positioned on the losing side of this pattern when debasement accelerates and restructuring arrives. Those who understand the pattern and move earlier toward real assets, diversified exposures, and structures that benefit from, or at least withstand, currency erosion do not just survive the transition, they often emerge from it stronger, owning a disproportionate share of whatever system comes next. So the real question is not whether Trump was right or wrong on tariffs, or whether China is purely a villain or not. The deeper question is whether you understand the machine within which all of this is happening, and whether you recognize that a 1.4 trillion flow into China during an alleged economic war is not an anomaly, but a signal of stage 4 in motion. As long as mainstream narratives keep you emotionally invested in the theater of trade wars, sanctions, and partisan blame games, you will miss the quiet, methodical repositioning of capital that always defines the late phase of a reserve currency cycle. By the time the majority finally realizes that their savings buy less, their retirement promises are fragile, and their currency no longer commands automatic global trust, the pattern has already completed another turn. Elites are comfortably anchored in the next architecture, and ordinary citizens are left asking the same question people in Britain, Weimar, and 1970s America eventually asked, when did this happen to us?